So what I'm going to try and do is use my colossal failures. Everybody likes to talk about their successes, but I'm going to use some of my colossal failures as examples of what I've learned. And by emphasizing what I've learned, hopefully some of it will ring true for you guys. And I think that the most important thing I can convey to you is help you get inside of the head of the investor. Because if you understand how the investor's thinking about things, it makes it a lot easier to sell. How many here are technology startups? How many here are non-technology startups? Are you in the services space? I'm just trying to know my audience a little bit. Services, or are they technology-enabled services? Some of them are, so I would include those in the technology. Children's clothing, so retail. I've tried that before. Based on the audience, what I'm going to try and do then is not totally focus on technology, although that's where most of my dramatic successes and my most colossal failures have happened, is in technology. A little bit about me. He read my resume, and how many here have ever been involved in a startup that was successful over, what people call a 3 to 5 year success path? How many have been involved in one that hits the traditional kind of success path? Okay, so when you started out and you made your first presentation, how much did the company look like that exited? Did it look like the pitch that you gave to the investor that raised the money? We used to call those turnarounds or workouts. They call it, the word pivot seems to be the operative word today. What I've also learned, and I know John will echo this, is that success very seldom happens the way that it gets defined in history. Success usually happens in ways that are transformative and where you're learning things as you go, and then everybody in a revisionist way then defines it like they knew everything going into it. And so a lot of the things I'm going to share with you is that failure happens in successful startups. John talked about Omniture, started out as Found, or whatever the first name of the company was. Went through about 15 different incarnations. But, I saw presentations from Josh James and his partner probably 30 times during that period. And that was a series of failures that turned into a huge success. So, why is this relevant? In the evolving capital markets, what you end up with is a lot of investors that are managing to a set of parameters or issues that you're not even cognizant of, you don't even understand, and you're wondering why they're not investing in you. So by way of context, what do you think the most significant driving factor or motivation for most venture capital or PE firms is? What do you think they are measured on? Take a guess. ROI, IRR. How does IRR get calculated? Against some hurdle rate. So it's basically a discounted cash flow with an accelerated IRR. He drew this funny thing up there where you invest capital and then you spend that money, and then eventually it turns into something that you can get value back on. That's called the J curve. That is huge in venture capital, not so much in private equity, but return on capital, all these things are things that end up being measured by the investors as incredibly important in how they get measured and able to raise money. You talked about Kickstart. It had a very successful fund, its first fund. Its second fund was even more successful. Now they're out raising their fourth fund. How many deals from their first fund are still in the portfolio? I would suggest there's probably a lot of them. A lot of them probably washed out or felled out, but they probably have a significant number of deals that are still in the fund from the first fund investment, and now they're out raising money for their fourth fund. Why is this relevant? Do your homework. Know who the investor is. Know where they are in the investment cycle. Know what their criteria is, because the more you know about the investor, the more you can cozy up with a story that will play to them. And if you have a story that won't play to them, don't waste your time. And I'm going to give you some metrics here in a second. So given the fact that over the last 15 years, the IPO market has gone down year after year after year, what do you think drives liquidity for traditional venture capital these days? You guys have any idea? What drives returns? What drives liquidity? M&A is huge, and we're going to talk about that in a second. What was that? IPO. Those are pretty rare, and I would say in the Utah markets they're really rare. Those would end up getting the focus. There's a new emerging class of buyers that are financial buyers, secondary market buyers, firms that essentially are active in deploying large amounts of capital into companies that have the potential of being successful, called growth equity. And I think in your slide it was called lower mid-market. Is that what you called it, John? So why is this so important in today's market? Lower mid-market is where there are a lot of companies that have ended up being staged where they've been incredibly successful over the last 20 years, but they've never been able to get a liquidity event for whatever reason. Cap structure, employee problems. So they're winning in business, but they're failing in terms of creating liquidity for investors. This is an important thing for you guys to understand because it affects the people that you're raising money from. This slide, if I can share anything significant with you today, it's the importance of this slide. The 4 M's. So, in my experience and what I've learned, and this is based on failures, there is nothing that can fix a bad market. Nothing can fix a bad market. What does that mean? If I start out in a market, doesn't matter if it's $1 billion, doesn't matter what size it is, if it's a bad market, if it's being overly complexed by a bunch of, or over-advertised or over-saturated, if it's fragmented, whatever market you're going into, you have to make sure that your story matches up with the opportunity, and you cannot fix a bad market. Investors hate this. When people come in with a market that they've already got investments in and they're trying to be convinced that there's some new solution that can solve it, and you haven't really done your homework, you can't fix a bad market. The second M is management, or people, or team. And if there's a team that understands its market, and that team is capable of executing in that market, that deal by definition becomes investable even before you know the third M, which is the machine, products, goods, and services. If you have a great talented team in a great market, I suggest that if you give them money, they'll figure out how to win in that market. I've seen it over and over. Now in Utah, for whatever reason, for years and years, and I was guilty of this, we used to start with the machine. We'd come up with some great idea, build a product, and then we'd think if we built the product, they will come. How many here have ever seen a product strategy, if it doesn't really understand its market, work in the first attempt? So that's what happens if you have a great market and you have a machine. What you end up doing usually is end up going at multiple attempts at that market and learning from the market until you finally get something that sticks. How much better would it be to start out with a market, understand the market, pick your path cleverly and clearly, and then build the solution that serves that market? That's very seldom what happens. What I see is go raise money and then build a machine. And that is so backwards. That's upside down in what really works. And investors are very wise to this. Money. I would suggest that if you want to be successful in raising money, find a mentor. And this could really be the fourth M. Find a mentor that really understands how to raise money and get them involved in your project. I've mentored a lot of entrepreneurs, and what I've seen with most of them is they idealize the fundraising process dramatically. John mentioned a guy that I know really well and invested in a couple of his companies, John West. John is a phenomenal fundraiser because he understands the mentality and the motive of the investor community. And so he pitches to them in a way that is very attractive to them. And it's really across the board. That's not something you can be taught in a meeting like this, but just understand if you have a mentor like a John West or Will West. John West was a great entrepreneur too. Will West, what you're going to do is you're going to learn from those guys how to how to approach an investor based on what their desires to invest in are, and you'll be able to raise money in a much more elegant fashion. So raising capital is more of an art than it is a science. One of the things that I've also learned is that trends come and go in investment communities. Some of them last 10 years, some of them last 5 years, some of them, flash and go. But one thing that has seemed to endure since my very first startup raising institutional capital in the early 80s is that technology seems to be an area where investment returns are always pretty solid. This is based on the fact that in any investor's portfolio and in any investor's fund cycles, there's usually one or two technology companies that can return the fund. And if you look back in history, successful fund managers usually end up having one or two deals that return the fund. Is that based on, in your estimation, is that based on the trends? How many here think that Google was a trend when they raised money and nobody could figure out what their business model, and some people still can't, but in late 99? That wasn't a trend. I would suggest it's still not a trend. Very few people have been able to execute on a strategy similar to that. When I was doing a startup in the mid-90s, very similar to what Google was proposed to fit into the trend, was called search engines. There was a company called Lycos, and we built a little company called Spry Inc., and Spry Inc. was the very first internet browser company, if you will, called Internet in a Box. And we sold it to CompuServe in 1994, late 94, early 95, for the first very significant internet transaction for $100 million cash. Lycos was the basis of the search engine, and what it was it was searching all of the then content companies, AOL and what was the other big one? The 800-pound gorilla?
Excite?
Excite was a search engine. Content, yeah. It was the bulletin boards. It was AOL was the consumer one, and CompuServe was the 800-pound gorilla in the enterprise content. And what we did is we just basically created an on-ramp into all of that information and allowed you to attach to it with the URL. And that's how that company ended up becoming successful. What were the failures along the way? The failures in that company were really related to the partners. And here's another important message in the mentoring category. If you find somebody that has recent experience in a space, whether it's failure or success, and you create a relationship with those people, and they create an access or a relationship with you with other people in the space, you end up getting the aggregated knowledge of failure or success across an entire marketplace. And that's why technology, I think, is an interesting place to go, because you can usually find, as John described, a lightning rod. The lightning rod, when we were doing Spry, was Eric Schmidt. You got to know Eric Schmidt. He was running Sunsoft. And this young entrepreneur was able to create a relationship with him. We were able to bring in John Wall. We ended up bringing in an aggregate of really successful players in internet as a technology, not as a business. And that really facilitated an outcome that was astronomical in those terms. A $100 million outcome in that market was significant. Let's go to the fourth M again, money. If you're going to raise money, find people that have done it in the space, find the partner in the firm and the attorney at the law firm, and line up the right players that have done it before and that you can have confidence in. And if they're really the kind of quality people that you want to have a long-term relationship with, they'll help you. And what they will respect more than anything else is sophistication, by the definition I just gave you. Mentors are very hungry to help entrepreneurs that are teachable and not know-it-alls. So from a technology perspective, identify the right players in the technology sector that you're investing in. Find a mentor, find people that will help you. And this might all sound like, remedial information, but it's surprising how many people don't take advantage of relationships that they already have access to. Not everybody's a professor, and not everybody's a young, heady new, recent millionaire. Go to some of the more aged people. And I'm going to give you an example. So my very first experience in a startup was a company called Computer Video Systems. And I was working as a project lead on a very large communication project for a defense contractor called Spare Univac. They're not even around anymore. And I got recruited into the company by somebody that had talked to somebody that knew me. And this guy that was probably in his late 60s was an engineer who had created some technology, and he wanted some help building a team and then managing that team to deliver on his idea. So we joined forces. And I learned so much from this guy that I can't even tell you. My life would be totally different if I wouldn't have had the opportunity of working with this guy. Guess what? We raised money before we had a CEO. And in fact, the way we raised money without having a CEO is we were teachable, we were hungry, and we were sophisticated by accident, not on purpose, by accident. We didn't know what we didn't know. And we were able to raise money, and we used the argument that we needed to raise money so we could afford to hire a CEO. That was part of our investment pitch. The next company that I did, the founders got together. We actually had a working prototype of the technology before we went and tried to raise money. There were 7 of us, I think, all technology guys. By the way, my undergraduate is in computer science, and then I got an MBA just so that I could argue with the finance guys in the room. The point I'm making, though, is that with each of these companies, how you approach the investment community was totally dependent on what we had that would be valuable to them in positioning it. And in that particular case, they brought us a CEO. The investors brought a CEO that they were willing to invest in. And it was a guy that was running a very large hardware company in Utah, and former IBM exec, and we were able to move forward with that company. Probably the most dramatic experience I had with the series of failures and incremental successes was a company called Trend Micro. Has anybody ever heard of Trend Micro? So when I met the 2 founders of Trend Micro, they were selling battery backup systems for NetWare servers, and it basically was a car battery and an elegant piece of plastic. That's basically what it was. And they had this interesting idea about doing virus protection. Viruses at that time were primarily boot sector viruses. They were on the floppy disks that got moved from machine to machine. And so you'd come in and you'd stick a new floppy in, and that file would then get laid onto the boot sector, and that distribution model, or that replication model is how they infected. These guys had come up with some technology. The technology actually was pretty relevant because they could do it quicker than anybody else. So we went and found a guy that knew NetWare, and we built a product called Land Protect, and it was the first network virus protection solution. Now here's where revisionist history would say that we looked brilliant, but we were really lucky because guess what happened within about 3 months of us creating this product? The market totally changed with a virus called Michelangelo. And the Michelangelo virus was the very first virus that was communicated or distributed in a network. So all the PCs that were attached to the network were instantly infected. Now there were a bunch of virus protection solutions that were attached to all the PCs in the network, but that's like building a fence when the virus is already inside. And so we were the very first server-based virus protection solution. That's how Trend Micro got started. That was in 1992. And in 1998, we took that company public behind some investment from Mr. Son at SoftBank. We took it public for a little over $700 million, and by the time I got out, it was trading in the 13 billion range. Ultimately trading on all the markets, not just the Nikkei. Now, the reason I tell you this story is because there's a series of failures between 1991 and 1998 that are incredibly relevant to this topic of technology. What do you think happened to technology between 1991 and 1998? The single biggest thing that's happened in my lifetime, the internet. So application viruses started happening, embedded viruses in XML. I mean, there was all these things that were happening. And so what we argued is you had to build this big company that could go and define ways to deal with all these viruses. The failure in that company is that one success, you can kind of rest on it. We went from zero revenue in January to, I think we had a $20 million month by September. That's hyper growth. But why is that relevant? Because the company had to have predictable, sustainable growth, not just growth. So I'm going to kind of back up for a second and say, what is the definition of an entrepreneur? And I'm going to use some examples that we've already talked about. There are two kinds of entrepreneurs that I've experienced, and this is dramatically oversimplified, but there is a subtle but significant difference between mentalities. There are what I call opportunists, and then there are builders. Builders tend to be at the salt mine every morning. They're not just working 80-hour weeks, they're probably putting in 100-hour weeks. They're the guys that are more interested, the men and women that are more interested in creating a successful company than defining themselves by the financial outcome to them. And they're probably more interested in seeing the investors get return than themselves get rich. Now, you could look at Josh James and those guys, and you could look at a lot of the other people. I mean, I sat next to Bruce Bastian. He was along with Alan Ashton. I was intimate with those guys back in the day. I was peers with the founders at Novell. Those guys were passionate about building something far more than they were creating a financial outcome for themselves. And what happened during that period from 1991 to 1998 at Trend Micro, it was all about building a business. And the difference between building a business and building a financial outcome for the founders was instantly observable by Mr. Son, by the Intel Capital people, by all the other investors that came in, and by the big banks that ended up taking them public. The failures along the way were when we started getting greedy in that process between 91 and 98, and we weren't sophisticated. We thought we knew more, and we started to go to the marketplace and tell the market how they should accept us rather than letting the market help us define how we should approach the market. Now I'm going to use a metaphor here that some people may appreciate and some people may not. In technology, as in all markets, I believe, people, companies, in spite of themselves, cannot create a market. I saw Intel try to do it multiple times, spend billions of dollars to try and create a market. Microsoft has done it. But markets happen, kind of like waves. How many here have ever tried to surf? What's the first rule? You have to pick the wave that you're going to surf. And not all waves are created equal for surfing, right? How they set up, how they come. And the really good marketeers and the really good salespeople read the waves and they pick a market opportunity that's a big enough wave that they can get a decent ride off of. Now, we've basically metaphorically said that $1 billion ride is what is required for investment. So what happens if you pick a $200 million wave? You're probably not going to be able to raise money. So in technology terms, these waves happen, and the best quality entrepreneurs identify those waves in a way that they can get value from them all the way to the beach. And this is what I call durability. So you have reliability, right? Reliable, predictable, and durable business value. I think when I look back at my experience in the hot bubbles that John alluded to, there have been a lot of companies that were able to raise a lot of money. There have been a lot of companies that were able to be very successful for a short period of time. But the ones that had predictable, reliable, and durable value to the customers are the ones that end up winning. How do you define durability and predictability in revenue? In technology, distribution is everything. Distribution is everything. I have had much better success with selling CEOs than taking some general manager out of a large corporation and trying to incorporate a general manager. The best CEOs that I've ever had are guys that were or women that were incredibly successful at being able to identify a prototypical customer that was highly repeatable. A prototypical customer that was highly repeatable. My biggest failures have been when I ended up with one customer that I ended up serving for a year and I could never make them happy trying to sell my product to them. That's not repeatable. How many of you have ever experienced that? And that customer ends up being your only customer ever, if they ever are a customer. So the most important thing that you can learn is how to identify repeatable, sustainable, and durable business based on repeatable customers. And that is called scale. And in SaaS models, whether it's users, whether it's revenue, what investors want to see in technology businesses is the ability to access scale. And we've talked about traction, we've talked about all these things, but what it really comes down to is scalable, reliable, really repeatable, and durable business. Does the durability have to be something that's defined in decades? No, but it has to at least last 5 years, which is the investment horizon for a VC firm. So if you're playing around in something that's at the edge of falling off or something that's trending out, just understand that, you're going to be significantly challenged. You have to make sure that you have this ability to scale. The next key learning and failure is, does the best technology always win? Rarely. I would argue that the most efficient distribution always wins. Probably the best example of that, and this is something that I can speak to with a lot of personal experience, is Mort Tolfer with Michael Dell at Dell Computers. Were they an engineering company? Did they add any value to the PC industry whatsoever, other than gross margins and efficient distribution? What you'll discover is that business model innovation sometimes might be as important as technological innovation, maybe more important to investors. And if you want to build a durable, sustainable, scalable business, you have to understand how that business model operates over time. It's not all about finances. Sometimes it's about channel partners. Sometimes it's about a big strategic partner. For example, when we did Ceracore and we sold to HP, we stumbled onto a significant need in the engineering design community where every major workstation vendor wanted to have some sort of a killer product to get in the door to sell their workstations, and that's what we became. And we raised tons of money from IBM, from HP, from then Xerox, Apollo Computers, a lot of the Route 128 workstation manufacturers. And ultimately HP bought it because Tektronix ended up buying another company, and that created a feeding frenzy, and HP and I think it was Nixdorf for Siemens got in a bidding war, and we ended up getting a great return on it. What we learned, and this goes back to the technology innovation curve and the value of knowing what you, or identifying what you don't know and finding mentors. It came down to hiring a few key salespeople into the company at critical times that had deep relationships with those partners. Is that okay to do? How many here have ever poached a big company for sales talent? Pick carefully, because not all sales talent at large companies is created equal.
Remember their sales guys too.
Yeah, but what I've discovered is if you can find a sales guy that really knows what he's doing, or a saleswoman that really knows what she's doing in the market that she serves, that, you know, sometimes it's like bolting a V8 onto a lawnmower, because if you have this little company, they can outpace you, they can outsell you through their relationships and their customers. So the last thing that I'm going to talk about from a technology go-to-market point of view, and these are all anecdotal and they're not written in any book, at least that I know of, is that go-to-market strategies are fraught with what worked last time should work this time. That there is some scientific methodology. One of my old partners wrote a book on it, Nail It and Scale It. I would argue that being close to the market and understanding your customers, not necessarily from what they want to buy, but turning them from you being a salesperson to them being a buyer. That transition is when companies blow up and scale. And if you can identify those moments in time, that's when, you know, world-class things happen. John was talking about being in the market with the Yellow Pages and putting it on the internet right when all the mini bells or the Selects were coming out and had to have a way to differentiate. He had an identified market. He figured out how to sell to them. Now, would that same strategy work today, John? Nope. Telcos probably aren't buying a whole lot of anything these days. So technology companies have this innate ability to create value for investors and for entrepreneurs. But in summary, the key things that you need to understand is what worked last time isn't going to necessarily work this time. The business model may be the most important thing that you hone in on. And make your mistakes quickly and then quickly move away from them. There's a guy at the back of this room that he and I have been in a lot of significant outcomes together. And probably the most colossal failure was one where hubris came in at the exact wrong moment, and we moved from the enterprise IT market to the consumer market at the exact wrong time. 2008, 2009, when all of the retail phone stores and everything were blowing up, everything was working, no matter, you could throw something at the wall and it would stick. Well, we moved at the exact wrong time, and companies like Radio Shack and all these consumer electronics companies just got nailed. The final thing that I want to share on technology, next to efficient distribution, and let's define efficient distribution for a second. Does that mean that it's low cost to build or low cost to maintain? Define efficiency.
I would say maintain.
You're exactly right. Some of the most efficient, look at Amazon, or eBay. They made huge capital investments, CapEx investments, over years to be able to access that efficient distribution. Dell, same thing. Huge capital investments in order to access efficiency. FedEx was the exact same thing. I mean, buying a bunch of airplanes and getting access to airports, all that stuff was hugely expensive. Once they got that, then they had gross margins to share. One of the things you'll also discover is you can get into this mode, it creates huge barriers to entry. Huge barriers to entry. First movers in distribution usually end up being the long-term winners. Why? Because first movers on distribution are a lot more sustainable, durable, and repeatable than those that have the best technology. I know you guys have probably heard this war story, but I was actually pretty close to it. How many here have ever heard the decision that was made for partnering with two companies that were on a watch list between CPM? Does anybody even know what CPM stands for? CPM was the operating system on all, it was CPM and ISIS were the two operating systems. One was built by Intel, and then Gary Kildall, who was an Intel engineer, left and created CPM. IBM came out with their new desktop computer that was x86 based, and they needed an operating system for it. And they went to Intel and they went to CPM, and they ended up not using those operating systems. Why? Because people got greedy. And there was a guy that had a vision. His name was Bill Gates, little office in Albuquerque. And he didn't even have an operating system yet. All he had was a basic interpreter. They walked in and he sold them something he didn't have, and then went and bought it.
Jim Patterson.
Yep, up in Seattle. I think it was called PDOS or QDOS or something.
Seattle DOS.
And that became what was IBM's disk operating system, and it ended up dominating. And why did he give them the operating system? Because he knew he could build apps on it and then control the application space. So when you're in technology, technology doesn't always win. I think the key point that I'd like to make for all you entrepreneurs as you kind of walk away from this, I had a couple of other comments that I wanted to make, but I won't get to those slides. They're largely repetitive. Maybe I can just pop through them. Oh, this is one that I'll just spend 1 second on. When you're picking an investor, don't inherently go into an investment relationship where there's going to be conflict within a short period of time. Now, there's always inherent conflict with investors over the long period of time. I've rarely seen it be sustainable because you end up in this conflicted position where they need to get liquidity and you want to grow your business. How do you create alignment? Pick who you take your money from. Not all money's created equal. There are patient investors and there are not so patient investors. If you're a technology company, find partners that have actually been CEOs or done their own startups and been involved in companies that are in the technology space. I don't know if you guys know this, but over the last 10 years, almost all venture capital firms are stuffed full of partners now that have never made a payroll in one of those companies. And I always tell entrepreneurs, if you can't find a partner in that partnership that made a payroll on their Amex card, they're probably not for you. Because I guarantee you that John has. I've done it. And if you've never done that, when you're looking across the table at an entrepreneur that's, you know exactly how they feel, you're going to get a different response. So creating alignment with your investor is absolutely essential. And part of this sophistication is you don't have to know everything about the investor. I think one of the presenters actually came in and asked you to, ask questions at the end of the presentation. It's much better off if you go in on Venture One or one of these search sites and find out as much as you can about the partner. Just like in law firms, all partners aren't created equal. Same in venture capital firms. Same in angel companies. Identify people that kind of align with what you're trying to achieve and have that set of experiences. So I'm going to go to my conclusions. How you fund your company is impacted by the liquidity horizon of your investor. What I'm seeing a lot more of today is debt structures, creative debt structures. And this might sound really weird, but one of the major taboos when I was doing my deals was you had to be a C Corp. I'm seeing a lot more deals where they know that the liquidity horizon is going to be out there ways where they're doing LLCs, and investors are coming in and actually investing in LLCs in institutional money where they have UBIT issues, which is the reason why C Corps are so relevant, and if you're going to do an IPO. Why is this relevant? Because if you have a C Corp, you end up with double taxation. That's just something you need to know. And one of the ways that you can keep investors comfortable and happy over time is if you can push money their way. If you're being profitable and you haven't hit a liquidity event, how nice is it to get a dividend check, John? Especially if it's an LLC and you get it as K1 income and it's not double taxed as a corporation. I'm seeing that a lot. And they have blocker companies that are set up, and some firms in the Bay Area are really good at it. I think there's some here in Utah that can do that. We already talked about alignment. Fund LPs, even the very large ones like the big insurance companies, et cetera, have moved more to a direct investment model. And they pick the funds that they invest in a lot of times for deal flow. And they'll cherry pick the best deals and load up in the later rounds. Know that about the investment firm. How does that affect what you're trying to do? Identify funds that have, if you're a financial service provider, identify funds that have big financial investors. There is no doubt in my mind that you can't anticipate getting a liquidity event in 5 years right now. It's very, very rare. I'm involved in several companies that are 20 years, 15 to 20 years into a 10-year fund cycle. And they're some of the best companies in the portfolio. They're huge. You can't kill them with the stick, but because of where they are, their valuations, et cetera, it's hard to get liquidity on them. So that's another reason to try and anticipate that. I think that investors are also mindful of the fact that over the last 20 years, there's been a lot of startups and there's been a lot of companies that have kind of survived to that $30, $40, $50 million run rate, and they've got their year-over-year growth that's 5 to 10%, and they're substantial and they're relevant, and they can get access to those for a lower valuation than some startup with two guys in lawn chairs in a garage. This actually is an investment strategy for some of you, and I've seen it work, especially in the Bay Area. Some of these companies have aging technology, they haven't invested, they have great customer bases, they have cash in the bank, and they have a bunch of really, really excited investors about trying to spiff up the new entity. Now, we did this with Penguin Computing. We came in and tweaked it to what they call high-performance computing on demand. We just basically reincarnated it from a hardware company to delivering high-performance computing over the internet. And that's just, the company's blown up. It's doing great. So sometimes a partner doesn't have to be, one of the Fortune 5. It can be a small company, sub $100 million in revenue that has all the assets that you need, and you can come in and raise money by showing how you can be a bolt-on strategy to accelerate to an exit for the investors. There's a whole bunch of other strategies. The one thing that I'm absolutely sure of is that the entrepreneurs in this room are going to be the ones that solve the funding problems, the funding gaps, because they always have. They're going to be the ones that find those great waves washing into the shore. And whether it's technology, services, healthcare, whatever it is, entrepreneurs will figure out how to solve it. The U.S.'s biggest strategic asset is the fact that we've been able to, in spite of regulation, in spite of everything else, is give access to entrepreneurs to fairly low-cost capital, year after year. And I guess my closing comment to you is, in summary, is that it might not be a formulaic answer for you. Some of the most successful companies have done it in what you would say very arcane ways. But don't think you're smarter than everybody else. Try the tried and true paths first before you go and invent something new. And focus on these key principles which I've shared with you, which is there is no substitute for long-term, sustainable, reliable, predictable growth, and that market matters and people matter a lot more than the machine. And if you do that, you'll be able to raise money. Thank you.